Hello MBA 503 students again. This is the fourth video in the series on financial statement ratios. These ratios are very important because they're market-based. These are shareholder ratios. You can call them shareholder market ratios because they really judge whether or not a company's stock is appreciating sufficiently and whether it's paying enough dividends. And of course, that's all relative. It's whether or not you're paying enough dividends depends on the quality of management, whether the company has anything better to do with your money, because it's your money. And well, let's get right into this. Okay, so we go here with the see if I got the right one here. Yes, this is the right one. Okay, so we'll go to the slideshow here. And I'll be opening up the worksheet for Pfizer again, but these ratios, a lot of them have very easy inputs. So we'll go from the beginning. And I've been through all this. There's four groups: liquidity, leverage, shareholder, accounting returns, and liquidity ratios. These are four liquidity ratios, which I've gone over in previous slides. So I'm just going to go ahead and get this one quickly. Okay, so shareholder return ratios. Okay, the first shareholder return ratio is an accounting ratio, and it's basically net income over shares outstanding, earnings per share. Now you'll see that I take out preferred dividends. I'm not going to do that in this case if there are any preferred shares at all. And that's because common shares are the shares that are voting. They're supposedly the real owners of the firm, so they can vote. Preferred stockholders generally cannot vote. So they have preferences in dividend payments. They're called preferred shares because they generally get dividends before common shareholders, but common shareholders are very much the owners of the firm and get the real vote. So generally speaking, we're going to use net income divided by preferred dividends. Now I'm going to go back here to the worksheet here. And so we're going to use net income over common shares outstanding. So where do I get these numbers? On the sheet right here. Here's my usual Microsoft stuff. Okay, so net income. Okay, well, we're going to take net income directly from the income statement. So that's the easy part. So we're going to do equals, and let's go over to the income statement. And net income, it'll be net income attributable to whatever company you're looking at. Now notice, just as an aside, notice that we used this number for times interest earned before taxes, and that's actually correct because you don't want to include your taxes in there because they're really not part of operations. They vary according to the talent of your accountant. And we could have actually made a smaller adjustment for interest expense here, but I didn't, just to keep this simple. We'll do that later. Okay, and if you come down here, there's a section called discontinued operations, which for now I would explain that, but these are gains and losses from operations that the company discontinues. Like, let's say Pfizer has a division and they sell off buildings, they have a gain or loss on that. Okay, generally speaking. Okay, and that this net income attributable to non-controlling interest, that has to do with mergers and acquisitions. When, let's say, Pfizer buys another company and it only buys 95% of the stock. 95% gives you control. Anything over 50% gives you control of the company. But that means if they buy 95% of the stock, 5% is what we call non-controlling interest. These are shares that don't belong to Pfizer. And so in order to get the balance sheet to balance, ultimately we put this in there. And so net income attributable to Pfizer is the one we're going to want. Okay, so net income. There it is, net income. Okay, number of shares. Now you may be saying, where do we get number of shares? It's very easy. Number of shares is obtained. Number of shares is obtained from the income statement. Now, it's a balance sheet account, really, because it's equity, but it just so happens, and I want to point this out to you, that the earnings per share calculation is really done on the income statement. So we should end up getting $2.92. Now, I'll show you how they're getting that $2.92. What they're doing is they're taking the net, exactly what we're about to do. Well, let me get the shares in first. Well, I can do this now. I'll get the shares in, and then I'll make the comparison. Okay, statement of income. The shares you can always want is you go to the very bottom, and you'll see weighted average shares basic. There's two levels of earnings per share, basic and diluted. I won't explain them now, but you always want the basic, okay, at least for our purposes. So we are going to put that over 5569, and we're going to end up with earnings per share of $2.92. I'm going to go ahead and format this. Okay, so we're going to take the format. We'll do currency, and we'll go 3 spaces out. Okay, so $2.92. That's our earnings per share. I'm going to say here, higher the better. I'm going to put here, relatively speaking, in simple terms, the higher the better. But what people really look for, and what the stock market and analysts that I was talking about before really look for, is growth in earnings per share, year over year, quarter over quarter. They really want to see your shares, your earnings per share growing. That's the key number in all this, driving the market. Okay, so anyway, one thing I'm trying to do is, you'll notice you have $2.92 here. And let's take the dollar, let's reformat this, take the dollar signs away. Let's call it a number. So they have 5,569 shares and whatever. And the higher the better. That's obvious. You want to make more money per share. You want your net income to be as high as possible, and you want your earnings to be as high as possible. The higher the better. But I'm going to put over here expected growth is key. Alone here. Okay, expected growth is key. So generally speaking, the higher the better. But you ask yourself, how high is better? When do you know you've reached a target? And that's where the analysts' estimates are going to come in. We're going to look at those maybe very soon. And what the analysts on Wall Street do, remember I emphasized Wall Street in the first video we ever did, is they take guesses at how much a company is going to earn. So, and that's your target. You want to, when your earnings come out, you want them to have beaten the analysts' guesses. So maybe 20 analysts follow Pfizer, and their average guess is $2.90. These shares would beat it, and that would keep the stock price, at least maintain stock price, depending on other factors also, especially revenue growth. But if you beat the analyst estimates, good. If you come in short, not that bad. Okay, and so we'll go over the analyst estimates in maybe a video and in class. This is something the book did not talk about, okay, but which is incredibly important. Now you look at all these other ratios. Dividends per share, DPS, stands for dividends per share, and you'll remember that we calculated dividends per share up here. So all you got to do is come down, and dividends per share is equal to $1.44. Now dividends per share, the ratio is just dividends per share over earnings per share. Okay, and we're going to divide that $1.44 by 292. You get 49 cents per share. This is pretty good if you're a shareholder. This says that for every dollar the company earns, for every dollar it earns, it's paying to its shareholders nearly 50%. So if they earn $1 in earnings per share, they're paying out 50 cents on the dollar. So from a shareholder perspective, it looks like Pfizer, large part of the attractiveness of the stock may be the dividend it's paying. So we may find out that your company is a bit of a cash cow. But anyway, so let's go back and just take a look at summarizing the points on this dividend payout ratio, dividends per share over earnings per share. And dividends per share, we already did that, the first video we ever did on this. Total dividends divided by common shares. This ratio measures the percentage of counting earnings that are paid out as dividends. A ratio of 40 cents, for example, would indicate that 40 cents is being paid out for to every common shareholder for every dollar of accounting earnings. That's a great explanation. I'm patting myself on the back. And whether a high or low ratio is desirable depends on the company's management, and that's very true. Okay, that is very true because some companies pay 0 dividends per share. You may think, so why would I invest in such a company? Because the stock price, because they may be able to take all their earnings, reinvest 100% of them, and get the stock price growing at 50%. Apple, around 2012, paid 0 dividends. But then if I invest in Apple, they would double my money in 2 months. So why would I want them to pay me dividends when they could get me 100% return in 2 months? I could never do that on my own. So that depends on the company and the quality of management, the innovation of the products, the innovativeness of the product, and all that stuff. Okay, so let's go back to the slideshow to make me feel better here. Okay, and back all the way over here. Okay, so the next one is the dividend yield ratio. Okay, the dividend yield ratio is dividends per share over share price. Very easy to calculate. We've done all of the inputs to this ratio. Okay, and this ratio measures the cash return to dollars. It is compared to interest rate. Of course, the DY ratio should be higher since investing in companies should be riskier than should be higher than basic bank account, since investing in companies should be riskier than putting money in a bank. Now, what you do with this ratio is going to be a percentage. It's going to be between 1 and 100. And so it's going to be 1% or 100%, which is 1. And what this tells you is if you invest $1 in the stock, what percentage of cash return are they giving you? Okay, so let's go ahead and look at the ratio for Pfizer, and I'll put more detail in there. Dividend payout ratio. Okay, that's dividend yield ratio we want. And notice that we already have dividends per share here, so let's just copy down from there, link everything. And we already have the stock price at the end of the year. It should be way up here. Share price $38.78. So your dividend yield is $1.44 divided by $38, $39, 0.037. That is huge. And I'm going to put a percentage. I'm going to format this to be a percentage because I'm sure you all understand percentages. But I'll go out 3 spaces here. That's huge. And let's put it this way. Pfizer's stock their sales have been flat. We'll take a look at the stock chart at the end of all this. And but let's say Pfizer's getting slow growth over the years. And that wouldn't be a very attractive thing to a shareholder. What dividend yield is telling you is that for every dollar that you invest in Pfizer stock, it's paying you $1.44 or close to 4% on that dollar. Now, who wouldn't like that for their retirement account? Anything paying 4% nowadays is golden. So dividend yield, I believe that dividend paying stocks, like, I wouldn't say all companies now, but like pharmaceutical companies, some banks, or the large banks, believe it or not, are doing well. So you compare this to an interest rate, and of course this should be higher because stocks have risk. But if interest rates are paying 1%, a stock is paying 4%, that extra 3% would be pretty attractive to get you to buy the stock, as it's a risk premium. Okay, so anyway, so that looks pretty good. And I'm going to say generally, and I put the word generally there because you have to look at the whole situation. With all these shareholder return ratios, you have to look at all of the entire situation. You look at all 4 things together. You want to make sure that they're not paying out too little dividends or too many dividends. If they have things they can invest in and grow the stock, they're paying out too many dividends. But if they have a lot of excess cash and not enough projects to put them into that would return and give you a good stock appreciation, then you want some dividends back. Okay, so it all depends on the dividends. So they're paying 50 cents out on the dollar of earnings. Okay, and dividend yield is an interest rate. That's a really high yield, believe me. Okay, so what I'm going to put here for dividend payout is depends on quality of management and growth prospects. And by growth prospects, I mean projects such as a pharmaceutical project, phase 1, phase 2, phase 3, depends on the quality of management. How good is management at managing the firm and choosing the project, and growth prospects. Do you have projects? There are other projects available which can cause the company to grow rapidly. If there's a lot of growth projects, the company should reinvest in them and not pay out dividends. But if there's few growth projects, then the company should pay out some dividends. Okay, the final of these ratios, and I'm going to go back to the slideshow here. This is an incredibly important ratio, and I'm just going to tell you the theory behind this ratio because it is a finance-based ratio. It is this ratio combined with earnings per share, and what does include earnings per share, is like the ratio for asking yourself whether a company's price is too high or too low. Remember, we came up with a price of $39 more or less. You have to ask yourself, relative to other companies in the industry, is that price too high or too low? Okay, so let's go take a look at in the slideshow again. Let's take a look at the all-important price-earnings ratio. Okay, the equation for this ratio is, for the price-earnings ratio, is share price over earnings per share. Okay, the ratio is an important ratio in finance, which is used to measure how the market measures a company's future growth. Okay, and that's basically the story. High, and this is really relative because there's a lot of factors. You can't just look at a P and say, give it the general rule. I'm going to give you the general rule, but warning, 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 you must absolutely look at all other factors too, at the current company's current situation. High P, and this is what I say in the slide here, high PE ratios generally, be careful, theoretically signify that the financial market expect high earnings growth. And if you have high earnings growth, your stock price goes up with it. I mean, that's what the markets look for, is growth in, and I'm going to say this again and again throughout this course, growth in earnings per share. If the market thinks, if those all-important Wall Street analysts think that earnings per share are going to grow on a percentage basis high, you're going to get high growth, then the stock price will go up. If you get low growth, generally speaking, you have a flat stock price. Okay, so that's going to be very important. Okay, and high PE ratios measure, generally speaking, if markets think if high PE ratios generally mean that the market expects high earnings growth. We'll get into market expectations very shortly. This my grammar's off here because I did these. This is a beta version of these videos. But P ratios are frequently used to value stock on a comparative basis, but I mean between companies. So one of your first projects, real projects of this class, is going to be, we're going to take the ratios that we've calculated here for Pfizer. You're going to computing. I think I'm going to use Merck. We're going to look at Merck and see which company is producing, has better ratios. It usually equals out, but the P ratio between the two companies is going to be very telling. Okay, so let's go over here, back to the worksheet, and you'll see how easy this ratio is. Stock price, well, you already have the stock price. It was calculated up on top. The stock price is right there. The earnings per share, this is why it's so important, is because it's an input to a couple other ratios. And so let's see, your P ratio doesn't look too bad. This doesn't look too bad. P ratio of, and I'm going to format these numbers, and by I'm doing this not to be perfect, but to really try to emphasize that you have to think of the meaning of these numbers. I'm going to put times here. Label this times. Okay, so, and you'll hear, if you ever listen to CNBC or one of those Wall Street shows, a lot of times they'll say that the company stock price is 13 times earnings. Well, that's the P ratio, 3.17 times. This means, in general terms, and we'll see, and that's why I say you have to be very careful with this P ratio, because stock price is a very theoretical thing. Earnings per share are an accounting fact, even though accounting has its faults too, let's say. But stock price, we know, fluctuates. So as of December 31st, 2019, Pfizer's stock had a PE of 13.71 times 12 months ago earnings. This ratio, the best thing to do is compare it to companies in their industry. If you have two companies that are very similar and one's trading at a higher PE, that means the stock market is placing a higher value on that company. Anyway, so I hope these videos are helping, and there's a beta version, so occasionally I have a little grammatical error. So, but anyway, so let's go ahead and cut this one off, and I'm going to finish these videos with the accounting return ratios. You can see down here with return on assets, return on shareholders' equity, and gross profit percentage. Okay, so happy accounting, everyone. See you soon.